Hello everybody. In this video we are going to discuss about Ind-AS 23 borrowing cost. What is meant by borrowing cost and how can we give the treatment for borrowing cost. Now firstly we need to know about the borrowing cost means what. Here borrowing cost means cost incurred for borrowing the funds. There may be interest cost, there may be exchange difference on foreign currency borrowing up to some extent. So we know about the borrowing cost. One will be interest cost, which will be interest cost, and another one will be exchange differences of foreign currency borrowing up to some extent. Then this borrowing cost, how we can give the treatment for borrowing cost. If borrowing cost is taking for acquisition or construction of some qualifying asset, so there must be one qualifying asset and we are taking some borrowings for the purpose of this acquisition or for the purpose of the construction, then we need to capitalize it to the cost of that asset. So we are taking borrowing for the purpose of acquisition or construction of one qualifying asset. Whatever the borrowing cost, we need to add to the cost of asset, or it will otherwise recognized as an profit and loss account. This is borrowing cost. Now we should know about the qualifying asset means what. What is qualifying asset here? Qualifying asset means any asset. For example, inventory, property, plant and equipment, intangible assets or investment property, etc., which has to take some substantial period of time to get ready for its intended use or sale. So if you are going to sell or if you are going to use the asset, then it must take for time, substantial period of time to get ready for its intended. For example, that is installation or construction of asset is taking some substantial period of time. Now whatever the amount here include will be inventories, manufacturing plants, power generation facilities, intangible assets, investment properties, bearer plans, there will be. For example, we need to exclude the assets which are ready for intended use or sale when acquired. So if you are purchasing, we are going to use that asset, it is not considered as qualifying asset. Financial assets and inventory that are manufactured or otherwise produced over a short period of time. Now we need to what we are explained, the whatever the borrowing cost, we need to capitalize it. The borrowing cost will be eligible for capitalization. Now the capitalization cost, we will capitalize the amount. For capitalization, the capitalization will start, capitalization will be start. When will the commencement of capitalization? For firstly, commencement date of capitalization of borrowing cost, it may be capitalization of borrowing cost should start from later, means whichever the following we need to satisfy the conditions. We need to take some loans or we need to take the borrowing cost, we need to incur some borrowing cost, and we need to development or activities on the asset has to be started. So we need to incur the asset expenditure, we need to take the borrowing cost, and another one will be we need to take the development activities on the asset as started or expenses has incurred for whichever the asset which is later date, from the later date we need to capitalize that amount. Borrowing cost commencement will start. Now we are started. When will be cessation has happened, date of, if we have any cessation, date of capitalization of borrowing cost. So cessation of capitalization means here capitalization of borrowing cost should stop on date when the asset get ready for its intended use or sale. So if your assets are ready for intended use, we need to stop the capitalization of borrowing cost. If entity is completing construction of asset in part and each part can be used individually, then entity should stop capitalization of borrowing cost on completed part on the date when the part get ready for its intended use or sale. So cessation will stop whenever it ready for use. If we are constructing one asset on parts basis, individual basis, for individual basis, whenever it get ready for individually we need to take. For example, we are constructing one building which is going to have 5 phases or 6 phases of 5 underground, first, second, third, fourth. So once underground is completed, we are using that underground. First is completed, we are using that first. Second is completed, we are using that second. So the borrowing cost will be stopped whenever underground is completed, first is completed, second is completed. Or now another case will be, if entity has passed some development work on the asset for unnecessary reasons, then the capitalization of borrowings of cost on that asset will be suspended for such period. So suspension of capitalization, if the entity is stopping the work, the reason will be unnecessary reasons, then capitalization borrowing cost are also suspended for that period. Now we need to capitalize the borrowing cost. The capitalization borrowing cost, if the capitalizing borrowing cost has specific assets, so specific borrowing, we have specific use, or we are using the general borrowings. When it is specific borrowing, amount borrowed specifically for acquisition or construction of a qualifying assets, or we have general borrowings, that is all other borrowings of entity which can be used for any purpose. They applied for qualifying asset on any purpose. Here we need to assume that specific borrowings are firstly used to incur expenses on qualifying asset, and then whatever the general borrowings are used to incur remaining expenses on qualifying asset. Always we need to assume the same. For that we need to calculate the rates for specific borrowings. For specific borrowings, whatever the actual interest cost incurred on specific borrowing, irrespective of expenses incurred on qualifying asset on different date, we need to take the direct amount, that is specific borrowing amount, whatever the amount we are taking, into interest rate on specific borrowing, whatever the rate, into how many months divided by date of month divided by 12 months we will consider. Here month means here month will be taken from when, and when we need to stop here. So for simply the expenditure will be qualifying assets amount, specific borrowing amount multiplied with interest rate into the month divided by 12. So for this month, when we start, when we stop, so start from or stop to, so stop from. So from means here whatever the commencement date of capitalization, or if you have year beginning, whichever is later we will consider. And from that when to stop, here earlier, that is cessation of date of capitalization is happen or year end. So if you have year beginning, we need to start from year beginning, or if you have any commencement date, then we will take the later. Or if we are at the end of the year end, our cessation was happening in May month, so then we will stop year end or for that period. And if you have any investment income on temporary on the this specific borrowings, on any specific borrowings, is there any income was getting from that temporary investment, then we need to deduct that amount, then we will get the specific borrowing cost, we need to capitalize that amount. Then after that we will get how we will calculate the borrowing cost. So for borrowing cost we will take simply capitalization rate will be calculated here, weighted average rate will be calculated, or the capitalization rate. How we will get the rate here, whatever the total actual interest in all general borrowings. So whatever the all general borrowings is there, for all borrowings total interest we need to calculate divided by total amount of borrowing based on the weighted average on time basis. to multiply with 100, we will get the rate, capitalization rate. Then from that capitalization rate, whatever the amount on each date into that capitalization rate into month divided by 12. Here also same, month means what? Here the month means same, simply from or to, start from when, later of the commencement date of capitalization or respect to expenses incurred date. If we have started one building, first we need to use the specific borrowings up to the date, whatever the amount incurred. After that date we need to consider general borrowing. So here respect to expenses incurred date will be considered, or year beginning, whichever is the later. And it will stop. When will we stop? It will be stop when cessation date of completion. Cessation means the completion was stopped, or capitalization of borrowing should stop on the date asset get ready for intended use, or it will be year end. If it is year end also, we need to stop that capitalization for that period. Now expenses incurred should be considered as actual outflow basis. We should not follow the accrual basis here. So always we will go with the cash method. And borrowing cost already capitalized on qualifying asset till previous year should all be considered as the expenses incurred on qualifying asset for calculating of eligible general borrowing for current year. Now whenever we are calculating the general borrowing cost to be capitalized, whatever the eligible general borrowing cost we need to calculate it, or total actual interest on all general borrowings we will take up. So first we need to take the eligible general borrowing and total actual interest, whichever is lower will be capitalized to the amount. And whatever the total borrowing cost to be capitalized on qualifying year during the year, that will be specific borrowing cost plus general borrowing cost for year. If we have any specific borrowings are taken for more than one asset, so if we have more than one asset, then borrowing taken for more than one asset, then allocate that specific borrowing cost to all assets. How we can allocate whatever the borrowing cost into expenses incurred on one asset divided by the total expenses of all assets, the percentage will get. Then if we have borrowings was taken in the nature of the bonds, like issued at the discounts, then that bonds we are issued at the bonds bonds was issued, and the bonds was at discounted, then we need to use the EIR method as per Ind AS 109 financial instruments. And after that, whatever the capitalization rate, if you have any group asset, expenditure, how here is there parent is there, and so the point some circumstances including the weighted average for each subsidiary. Here if you have any group companies, then in the separate financial statement, how we can give separate financial statement of each group company, we need to apply the same principles whatever the Ind AS explained now. So same principles. After that, we need to capitalize the borrowing cost into qualifying asset in SFS of company incurred on qualifying asset by each company in the group. And after that, in CFS, here in CFS we need to remember one point. First point will be capitalizing borrowing cost relating to qualifying asset in CFS by considering the all borrowings taken by each company in the group and whatever the all expenses on qualifying asset by each company. But if is there any intercompany profit is charged on construction of qualifying asset within the group, then that such profit will be eliminated in the CFS while considering expenses incurred on qualifying asset. Now after that, we need to know about the exchange differences. Here exchange differences is there. On foreign currency borrowings is also treated as borrowing cost. Now, whenever exchange loss is arising on foreign currency borrowings up to the saving of interest cost, we need to treat it as borrowing cost as per Ind AS 23. Whatever the remaining exchange loss will be recognized in profit and loss account as per Ind AS 21. For calculation of exchange losses, we need to use the steps. So step 1, simply we need to calculate what is the actual interest using the foreign currency borrowing sum, and step 2 will be the whatever the interest if we are taking that loan in the home currency. So for that functional currency and foreign currency borrowing. So here we are calculated with the foreign currency borrowing. Here we will see the functional currency borrowing. If we will get any savings here, from that saving we need to calculate the any exchange difference. So step 3 will be exchange difference. Here the interest, functional currency, foreign currency is different savings. After that exchange difference, rates different, whatever the foreign currency borrowing amount and whatever the exchange rate at year end, whatever the exchange rate at beginning, we need to see the different. If this exchange different, it has the positive or it has the negative. When if it is a positive, it will become the exchange loss. If it is a negative, it will become the exchange gain. We need to adjust that. If it is a exchange loss, it will be transferred to profit and loss account. If it is a exchange gain, recognized in profit and loss account as per Ind AS 2. And here total borrowing cost on foreign currency borrowing sum. Here whatever the amount here saving, that will be considered here actual interest cost plus any exchange loss we are incurring for different foreign currency up to this savings will be considered as foreign exchange borrowing cost. Means if you have taken any loan in India, you are getting 1000 rupees. For the purpose you are went for foreign country, you are incurring some expenses of interest expenses of 800 and foreign exchange loss will be 400. For this 400 we will consider only 200 for the borrowing purpose. It is 100,000 and the 200 will be charged to profit and loss account. That is the main picture here. This is Ind AS 23. So what we are discussed in Ind AS 23, simply we are started with the definitions. In definition we explained about the meaning of borrowing cost. That is, it means cost incurred for borrowing the funds. It may be interest cost, it may be exchange difference on foreign currency borrowings up to the same extent. What is the treatment for borrowing cost? Borrowing cost is taken on acquisition of qualifying asset. Capitalize that amount of cost of asset. What is qualifying asset? Qualifying asset means simply it is any asset which is going to take the substantial period of time to get ready for its intended use. Here the substantial period of time is not defined under the Ind AS, so it will be as per the judgment of the entity. If it is, we will assume the taking substantial period of time to get ready for it. If it is not qualifying asset, we are incurred some expenses, it will be recognized as expenses in profit and loss account. After that we are explained about period of capitalization. When will commence the capitalization? So capitalization will commence when the asset loan was taken or development activities of asset has been taken or expenses of the incurred, whichever is later will be considered. And if when will be cessation? So it will cessations happen when the asset get ready for intended use, or we are completing some constructions in a part or individual basis. Up to that individual asset is completed, we need to calculate the amount. If any entity pauses development work on asset for unnecessary reasons, the capitalization borrowing of that asset will be suspended. We need not included in the borrowing cost. Or we have two types of borrowings. One will be specific borrowing, another one will be general borrowings. So specific borrowings will have amount whatever the borrowing specifically for acquisition or construction of qualifying asset. General borrowing means all other borrowings of entity which is used for any purpose. Here specific borrowing will be first used to incur expenses, and secondly for general borrowings. First capitalization of qualifying asset, we will take first specific borrowing cost. After that we will get the general borrowing cost. For specific borrowing cost, if any investment income for temporary investment, we need to deduct that amount. And borrowing cost, for the purpose of borrowing cost, we need to calculate the capitalization rate, whatever the total amount of interest incurred divided by the total amount, and whatever the eligible borrowing cost we will consider. And eligible borrowing cost or total actual interest, whichever is lower, will be considered for borrowing. And we need to add the specific borrowing cost plus general borrowing cost, we will get the total borrowing cost. And after that, if the specific borrowing is used for more than one asset, then we will calculate the proportionate basis. After that, we are discussing about the bonds. If we are nature of the bonds discounting, then we will use the effective interest rate method. And after, we are discussing about the capitalization of borrowing cost by group companies. If you have group companies in SFS, each group company will apply same principles, and capitalization of borrowing cost in qualifying asset is taking as and qualifying asset has incurred some expenses, then we will be considered. If it is a CFS, capitalization borrowing cost in qualifying asset, CFS by considering the all borrowing cost will be considered in a group basis, and all expenses of qualifying asset by group basis. Here one important point will be, if it has any intercompany profit is charging on construction of qualifying asset within the group, then such profit will be eliminated in CFS while considering the expenses incurred on qualifying. And after that, we are discussing about the exchange differences. Exchange differences, for exchange differences we need to calculate the first whatever the foreign currency borrowing amount. After that, functional currency borrowing amount, we will get the saving amount. If we see the different amount of these both, we will get the savings. Then we need to see that exchange difference. Up to this saving, we need to adjust that exchange difference, and excess of that exchange difference will be charged to profit and loss account. This is Ind AS 23 borrowing cost.